as I said, the first time in a virtual mode, but we still apply the same rules as normally. So we have each time interesting panels, after which there will be Q&As. There was a Q&A box at the bottom of the system, where you can ask questions, which the moderators will see and the moderators can ask. And for press, there is the rule, as we always apply, Chatham House rule, which means, let's say, that you cannot quote a specific speaker unless you have his permission. So you can quote the overall or give the overall thrust of the debate, but you cannot quote any specific speaker unless you speak to them. And with this, I pass the floor to Fabrice. I would like to say there will also be an initial question before the panel starts, or which you can fill in while the panel starts, just to give get a bit your ideas about the subject which we are discussing. So again, good morning, and thank you, Fabrice, for joining me now and for moderating this first panel.
Well, thank you very much, Karel, and welcome to everyone. I'm very glad that we can open the annual conference with such a distinguished panel with very direct actors of the Capital Market Union. And I'm very pleased to welcome John Berrigan, who is the Director General of DG FISMA, and that has produced an action plan in late September, which I'm sure he will comment on. And Stéphanie Yon-Courtin, who is Member of Parliament, Vice Chair of the ECON, and the Renew spokesperson on the Capital Market Union. Corinne Wortmann, who was co-chair of the next CMU high-level group and is chairperson of pension fund ABP, and Neil Moloney, who is professor at the London School of Economics and Political Science and well known as an author of a reference book and study on the European supervisory authorities. I hope we will have the opportunity this morning to discuss the state of the CMU file with a number of contributions. Of course, the action plan of the Commission based on the high-level forum work, the next CMU report that was produced a year ago, a very impacting resolution of the Parliament on a number of issues. So we have all the ingredients for a very fruitful discussion. What I suggest is that we start by asking you, John, to set the scene with a keynote speech and presentation of the Commission ambitions for the future, and then I will ask the members of the panel to give their comments, and I hope we'll have a rich discussion. Therefore, and I recall that there is a poll going on in parallel, if I understand well, where you could express your opinion based on your current feelings or after being convinced by the speakers on what the priorities of the CMU should be. Now, without further ado, could I ask you, John, if you could be kind enough to set the scene and we start.
Okay, well, thank you very much, Fabrice, and good morning, everybody. It's a great pleasure to be with you here at this ECMI conference, even if, as with so many conferences this year, we have to be content to see each other in virtual format. I mean, I quite like the title of this year's conference because it asks whether Europe's Capital Market Union is in sight. Personally, I would very much like to hope so, because some of us, including members of this panel, have been looking for it for a very long time in some form or another. So let's hope it is finally in sight. But joking apart, I think the conference is very timely. It follows nicely, I think, on the launch of the Commission's latest attempt to build a single EU market for capital in the form of the second Capital Markets Union Action Plan. And this morning, our panel will discuss a very specific aspect of that, and that is how capital market development can contribute to mobilize funding for a sustainable recovery. And I think this topic is even more timely because it links CMU to what I think is probably the greatest short-term economic policy challenge of our time, and that is how to navigate through and exit from the COVID-19 crisis. But let me start by saying maybe a few words about the new CMU Action Plan. So between 2015 and 2019, the Commission delivered on the first CMU Action Plan. But I think there can be no illusion that the integration of capital markets in the EU is even nearer complete. We clearly have a long way ahead of us towards a genuine single EU capital market. So hence the need to build on the progress we made in the first CMU Action Plan with a second CMU Action Plan. Even if it's not the most original title, it is a second CMU Action Plan, and it's important that we build on what we achieved in the first one. Now, we have based this second CMU Action Plan on output from a high-level forum of relevant and very qualified stakeholders, who in turn built on work that was done by an earlier group, the next CMU group, and we have Corian here, who's going to represent that group, and Fabrice was also a member of that group, so they're also strongly represented here today. So we drew on a lot of, I would say, stakeholder expertise, and through the forum, we received 17 recommendations and 60 plus sub-recommendations, so a lot of detail that allowed us to work on our action plan. And we built on those recommendations pretty faithfully, I think, and we proposed 16 policy actions with clear objectives and specified timelines. And there's a mixture of rather technical and targeted actions on the one hand, and then with actions of a more fundamental nature. But all of the actions, I'll say, are ambitious in their own way and are all likely to deliver concrete benefits once implemented. Now, we believe that the adoption of a new action plan is a signal that this Commission is as serious as its predecessor Commission was about advancing the EU capital market development and integration. And to this end, the plan has three core objectives. The first is to make financing more accessible to European companies. So here the main focus will be on sell-side conditions. The second is to make the EU an even safer and more attractive place for individuals to save and invest long-term. So here the focus is on the demand side. And I think an interesting point in this plan is that we do a little bit more work on the demand side than we have done in previous times. And then the third core objective is to integrate national capital markets into a genuine single market, which is, of course, a very classical objective and has been an objective of these initiatives right back to the mid-1980s, when unfortunately I started working on market integration. Now, to deliver on these core objectives, the plan identifies both legislative and non-legislative actions. And I'll just give you a few examples of these. The one is the creation of a single access point for investors to company data. So we believe that providing investors with seamless access to financial and sustainability-related company information will reduce information search costs. It'll widen the investor base for companies. It'll help to integrate smaller local capital markets, and of course, ultimately support economic growth. A second example, incentives for insurers and banks to invest more in EU businesses and invest long term. This will contribute to the re-equitization, if we can use that word, of companies. And this is something which is always important, but will be even more important, I think, after the COVID crisis, when corporate debt levels will have risen to even higher levels before it started, and they were already pretty high before the crisis started. A third example, reduction in informational overload for retail investors, and an accompanying increase in the quality of advice. And this combination is important because we believe retail investors should receive simple and easily comparable information on financial products, but they must also receive sound advice, allowing them to make the right investment decisions. There'll also be an effort to increase pension adequacy across Europe. This would help people invest long-term, so to get higher and sustainable returns, and hopefully a suitable complementary income for their retirement. We want to simplify withholding tax procedures. This will make it less costly for investors to invest across borders, and of course will also prevent tax fraud. We want greater convergence in insolvency rules. Making the outcomes of insolvency proceedings more predictable, we believe, will support cross-border investment. And every survey we do of market participants tells us that this is at the top of the list. We want to make an effort to facilitate shareholder engagement, and so make it easier for shareholders to have a say in how their companies are being managed. This is notably as regards sustainability issues. And then we want stronger rules for protecting cross-border investments. So this is just an example of some of the things we want to do. And all of these actions and other actions will, we believe, help to deliver CMU. And of course, delivering CMU is not in itself a goal, but we believe it's a must now if we want to address the economic challenges ahead, challenges that are both now short-term and longer term. And that kind of brings me back to the topic of our panel discussion and the fact that, as far as I see it, we need CMU now more than ever in view of the ongoing COVID crisis. CMU is needed to fund recovery, and that recovery must not only be a robust near-term recovery, or robust near-term response to the crisis, it must also be sustainable in a longer-term perspective. Now, a lot of attention has been focused on public sector efforts to stimulate post-COVID recovery. This is right, I think. I mean, Next Generation EU programme and the associated Recovery and Resilience Fund has attracted most of that attention. And this is correct. I mean, it is right to focus on this because this is an EU-level public funding initiative. It's complementing similar efforts at member state level, but it is historical in the sense that for the first time, the EU will raise funding collectively to invest in the EU economy. I think the RRF will be an important engine of economic growth in years to come. It will hopefully underpin economic recovery and also preserve economic cohesion in the Union. The RRF funding will also target a recovery that's fundamentally based on increased productivity, of course, but will also encompass the transition to a greener and more digitalized economy. But of course, meeting all of these interlinked objectives requires truly massive amounts of investment. It requires investment on a scale that public funding alone simply cannot deliver. So private funding has to be mobilized as well. And again, we believe that building a larger, well-functioning and integrated capital market, a CMU, will be a key part in mobilizing this private funding. But let me now maybe zoom in a little bit on the sustainable and finance and digital finance agenda, because these are the elements of the green and digital transitions that will be part of the short and long-term recovery that are most relevant for the work that I do, and I think for the work that people on this panel are involved with. The sustainable finance agenda and the digital finance agenda are both what I would call them children of the initial CMU projects. They were both part of the initial CMU Action Plan. They are now, of course, self-standing and rapidly expanding work strands of their own, albeit that they retain clear synergies with CMU itself. Sustainable finance, as you know, aims at ensuring that the financial sector reorients capital flows from projects that are harming the climate and the environment towards projects that will bring a substantial positive impact. And the objective here is that the financial sector should play its role in delivering the targets embedded in the European Green Deal. And to this end, the Commission, we will bring forward a renewed sustainable finance strategy, probably early next year now. And this strategy will build on measures taken so far, notably the development of the EU taxonomy, the disclosure regulation, and the regulation on benchmarks. In next steps, we will revise the non-financial reporting directive. That will probably be in Q1 next year. And here the idea will be to strengthen ESG disclosures by corporates. This will include reporting on taxonomy alignment of their revenues and capital operating expenditures as mandated. We're also working on developing EU standards, such as an EU green bond standard. There we look to propose something in the first half of next year, and labels for sustainable financial products via the eco label. And all of this is to protect the integrity and trust of the sustainable finance market. They will all make use, of course, of the EU taxonomy. I think the potential of green bonds to finance the green transition and support the European Green Deal is enormous. And of course, Europe is already leading the way in the issuance of green bonds globally. And of course, President von der Leyen has committed a substantial portion of the next generation EU issuance will also be green. So all of these actions in the area of sustainable finance, I think, are designed to allow investors to identify what is a green activity and to invest in that activity on a sound and still profitable basis. They're in a sense creating a toolbox that will allow private sector funding to play an essential role in the transition to a sustainable economic growth path in the EU. Which begs the question, what exactly is the connection of this to funding the post-COVID recovery? Well, I must say some have argued that there is no connection between the two. In fact, some have even argued that there's a connection, but it's not a good one, and that they're concerned that there may be a trade-off between speed and sustainability in funding the recovery. Personally, I don't see that trade-off as being very real. I mean, if we fund a recovery that is rapid, but ultimately ends up stranding lots of investment as not sustainable in the near future, I think we'll not only have wasted a golden opportunity to transform the economy, we will also have saddled future generations with a deadweight of public and private debt that is not invested in a way that can remunerate itself. So we really have to combine speed and sustainability, and I don't see a particular trade-off between the two. As I'm running on time, I'll turn to digital finance. There it's clear that consumers and businesses have been increasingly accessing financial services in digital form, while innovative market participants are developing new technologies and are challenging traditional business models. And this trend has only been reinforced by the consequences of the pandemic. If there's one sector which has benefited from the pandemic, it is the digital sector. And the very fact that we're communicating as we are this morning is evidence, I think, of that. I think digital finance has already helped citizens and business to tackle this unprecedented situation. And so we have decided to kind of build on this and presented a digital finance strategy to set out how Europe can take advantage of this in its recovery strategy and in the longer term, with digital technologies being key to relaunching and modernizing the European economy across many sectors and moving Europe forward as a global digital player. I think we have to be honest here that we are certainly not the leaders in the digital field. We suffer there because we lack scale. And an important part of the digital finance strategy is to provide opportunities for innovative businesses. And there are plenty of innovative businesses in Europe, but they lack scalable opportunities. And the finance strategy is to give them those scalable opportunities and to allow our players to compete with those in other parts of the world. We think if we embrace this agenda, we can unleash European innovation, we can create opportunities to develop better financial products for consumers, including for people currently unable to access financial services at all. And also it will unlock new ways of channeling funding to EU businesses, and in particular to SMEs. So I think, again, linking it back to the panel title, boosting digital finance can support both the near-term economic recovery and the longer-term economic transformation. It can set up new channels to mobilize funding in support of the Green Deal and the new industrial strategy for Europe. And as digital finance accelerates cross-border operations, it also has the potential to enhance financial market integration in banking and capital markets, and all of these in a mutually reinforcing way. So let me conclude by just recalling what I said earlier, that the COVID-19 crisis, in my opinion, has made CMU even more relevant than before. I think it's hard not to feel that the EU economy would be better positioned, better placed to weather and exit this crisis if we already had a large and developed EU capital market. Unfortunately, we don't have it. But even if we don't have it in place now, I think we can continue the process of building it in a way that funds a robust recovery in the short term, while also ensuring that the economy transitions to a more sustainable and digitalized growth model in the longer term. The Cmu Action Plan, in conjunction with the sustainable finance and digital finance agendas, are key elements of the Commission's contribution to this effort. And I think in this way, we recognize that funding a sustainable economic recovery cannot be left to the public sector alone, and that private finance has an even more important role to play. So maybe, Fabrice, I will leave it there and hand it back to you. Thank you very much.
Well, thank you very much, John. That was very informative, and we can be only in admiration of the amount of work that you are preparing for yourselves, and you cover a number of significant areas that might be really transformational. Now, maybe I give the floor to Stephanie, because the Parliament has been studying this deeply and produced a very rich report on what it sees as the priorities. And we all know that you have been very active in the drafting of that resolution. So I give you the floor.
Thank you, Fabrice, for your kind introduction. And I'd like to thank very much ECMI for its invitation. I'm delighted to be part of this panel with distinguished speakers that have worked on building the Capital Markets Union for so many years, maybe even before Capital Markets Union was the name. So as you know, the European Parliament has adopted this vision for the next CMU a couple of weeks ago. I can assure you that there is definitely a strong support across all political groups to make the CMU a reality for our citizens, for our businesses, and especially for SMEs and mid-caps. Also, as John very again highlighted, digital and green finance transitions are definitely key priorities, unanimously shared. These are definitely new opportunities to what we have to take advantage for enhancing the capital market that we need. The new Cmu Action Plan is definitely full of ideas, many good inputs, and some of these ideas are reflective of the Parliament's own initiative report. However, to me, there is a key ingredient for a successful recipe which is missing. It's trust. Trust in an ambitious vision for the CMU. Much like Rome, trust cannot be built in one day. It cannot be built through regulation. Regulation is key, but it's not enough. Trust has to be created over time, if and only if everyone shares this ambitious vision. Without trust in equity financing, our SMEs will not take the plunge and transform the creativity of European entrepreneurs into jobs for tomorrow. Without trust in financial products, our citizens will not invest their savings into the European recovery. And in my view, as Renew spokesperson on the CMU, these two challenges should be definitely our compass for every action until 2024. In 2024, SMEs and companies should gain effective access to equity financing, especially if they contribute to the digital transformation and to the sustainable transition. This is definitely at the core of the Renew for SMEs initiative that we are supporting. And this means, I think, at least 3 priority actions. The first priority is the everlasting questions on investment research for SMEs, which should be solved. I realize that we still have not found the silver bullet somewhere, but we should keep looking for the right solution or the right set of solutions. The second priority action, to my mind, is the definition of SME in all financial legislation. It should be streamlined. This will definitely help our entrepreneurs understand the rules applying to them and from which they can benefit. Third, I think key priority action is SME should be spoiled for choice when looking for investment beyond bank loans. Initiatives like a European fund for IPOs, a simpler prospectus for SMEs, and tax incentives for investing in equity are definitely steps in this right direction. In 2024, European citizens should be more active with their savings. They need to become consume actors. directly investing in the European recovery. And I have three main ideas in this regard. Employee share ownership, which should become the norm in Europe. This would be a very strong lever for a faster recovery. Consumers also, and this is the two idea, should be at the center of the European approach to transparency on financial products. This means fixing the PRIPS skid in the very short term, and in the medium run, update our rule book to inform consumers the same way when they are buying financial products online and offline, and to build on the strong demand for ESG products. And third main idea to have more consum actors is consumers should always be protected and offered a better choice of suitable products, whatever the manufacturer, whatever the distributor, whatever the product. More harmonized rules on the distribution of financial products, I think, is a must. Well, in short, we should trust each other to achieve this ambitious vision, more equity financing for our businesses, and more direct investment from our citizens in the recovery of the European economy. And when we talk about ambition, we need to talk about supervision, as mentioned in questions on the chat already from Mr. Mendes. The first ESMA assessment of the Wirecard scandal shows again that we need a strong European supervisor, a supervisor which is able to challenge and to ask difficult questions to national supervisors, especially when they are too close to certain companies. So I said, I think CMU ambition has to walk on its two legs. Regulation is one leg, trust is another leg, if we want the capital markets union to work properly towards a rapid, efficient, and real recovery. Thank you.
Well, thank you, Stephanie. This is extremely clear. You have clearly identified your priorities, and maybe I can give the floor now to Corinne. I heard in the introductory keynote speech of John some mentions about pension adequacy, investor protection. I know these are issues that are very important for you, but not only, you have been thinking about the whole architecture of the CMU. So please give us your remarks after these two initial statements.
Yes, well, thank you, Fabrice, and I'm very happy and that I can join this panel. Although it's digital, but it's important to discuss the topic, because it's getting more and more important that action will really deliver results. And at first, I would like to welcome, John, the holistic approach you presented. Although sustainable finance and digital finance are separate programs, you presented it as a holistic package. And I think that's important, because that's why, at least in the analysis we made in the next CMU, why the first action plan didn't deliver what the level of ambition we wanted. It was more or less a package of highly technical legislative proposals, and success was measured whether or not these proposals were successfully implemented. And through the bottom-up approach, which we took as next CMU, but also a group, but also the high-level forum took, the political involvement already in an early stage through the ECOFIN conclusions, that helps very much to make it a more to take care that it will gain more political support and more attention. And what I would like to also link it to Stephanie's mentioning the importance of trust. Trust in the financial sector, we all know, is still a very delicate issue, still very much questioned. What we did as a next CMU group, we put the purpose of the next CMU, of the CMU, in the heart of our approach. because capital market investments are more and more important. There's an urgency. There was already an urgency through Brexit, the trade tension, the climate change challenges mentioned by both of you. They require massive investments, long-term infrastructure, private funding is definitely needed. But in addition to that, the economic recovery post-COVID underlines the need for innovation and digitization. When you take this and when we want to gain trust, it's important to put the purpose of the CMU in the heart of, in the center. And that's why I like your holistic approach, John. And that's why we proposed to change the name of the project into a capital, to change it into a sustainable investment union. The Commission didn't took it. Parliament supported this, but it's important to link it to the citizens' need in order to also get the political support needed, both on the European level and on a national level. I experienced the importance of the issue also through my role as chairman of the ABP pension fund. We are a pension fund with 3 million Dutch participants. We invest 460 billion euro. Half of it is invested in the European Union. And we attach great importance, and our participants attach great importance to sustainable and responsible investing. That's centered about around three transitions who very much link to the challenges the European Union is facing, which is the energy transition, the transition towards a circular economy, and the digitization. So this very much connects to each other. And for that, we need, for our participants, we need the long-term investments, and that's hopefully the Capital Market Union initiative will bring this, will present more opportunities in this respect. John, you mentioned more work needs to be done on the demand side. Of more work is done on the demand side in the action plan. I would like to welcome that. Because the importance of long-term savings through collective pension funds, but also through retail investments, both are important for pension adequacy. And I really would like to give support to the proposals you presented. You also mentioned the importance of sound advice. And in that respect, well, we called it in our next CMU report, fair advice. But there the proposals could be more ambitious because, for instance, the experience or evidence in the Netherlands show that introducing an inducement ban delivers much stronger competition, lower costs, but a higher uptake of simple and fair investment products. I very well know that this is a sensitive issue, but steps in that direction will definitely help to give better advice and to deliver better products to our citizens. The long-term investments, the way the Green Deal and sustainable finance package are presented are very supportive, as you also already mentioned, John, to the public-private partnerships to support that. It's important that the European initiatives complement and give the right incentives to capital markets investments. Therefore, ambitious CO2 pricing is an important instrument. Then business cases can be more attractive in an earlier stage. So that's an important one. And also the role the EIB and EIF plays. They should complement market investments. It's very important, and I know there are several initiatives to take care of that, the public money is used for, say, the risky part of a project, the part which delivers the public interests, and with that make it possible to have a good business case in an earlier stage. Last remark I would like to make is, well, success of the program, I started with that, is not only that a package of legislation is successfully implemented. It's in the end, it is results for the citizens. Do we achieve the goals in the real economy? It's also important to measure that, because not only initiatives on the EU level, but a lot of action and initiatives have to be taken on the national level. Well, in next CMU group, we proposed to establish economic KPIs, which should be regularly monitored. Also, the IMF has a kind of an instrument in that respect. When you monitor that through a pre-agreed mechanism, well, it's better to track, you can better track progress in member states. Well, it's a kind of a mechanism which makes it transparent and also initiates discussion on the progress made. So, but the Commission didn't took it. I'm really interested, John, to hear from you why you didn't do that, because I think it's important that finally we achieve results for the citizens and for the real economy, because that's the only way to gain trust in the end. Thank you.
Thank you very much, Corinne. That was a very inspiring, I would say, for the best way to build the program for the future. Can we move now to you, Niam, and maybe from an observer or academic viewpoint, how do you see this progressing?
Thanks so much, Fabrice, and it's a huge honor to be here this morning with such a distinguished colleague. So thank you also to ECMI. I mean, I think first of all, I would very much warmly welcome this reboot of Capital Markets Union from the Commission. I mean, clearly, private sector mobilisation is absolutely critical here in terms of the balance of funding into the economy. I think I'll confine my remarks to what I think is critically important in the new action plan, which is the demand side. And it was wonderful to hear John this morning focusing so much on the demand side. And again, as you know, Fabrice, I have the luxury of being an observer. And I think one of the things that strikes me very much over the last 10 to 15 years is there's very often a rhetoric about mobilizing household capital at critical moments of crisis in the European economy, and perhaps not enough of a focus on how you do that. It's an extraordinarily difficult thing to do, to mobilize household investment in a safe manner. And that's why I'm very reassured by the centrality that's given in the Commission's action plan. And if I might make one or two brief comments as to why it's so important right now, I think we're slightly heading into a bit of a perfect storm here. I mean, as we know, we're in a lower for longer paradigm. Lots of talk about lower interest rates, perhaps charging for deposit accounts. There's going to be great pressure to look for yield for households to fund their future, to fund education, to fund welfare. Where do you go to find those returns? In combination with that, we also know that the household savings rate is going up quite significantly in some aspects of the European economy. So we have a buildup of savings, we have pressure for yield, and thirdly, we have this attempt to mobilize household investments, and the market will respond to that. So I think there's a potentially very dangerous moment here in terms of products coming on the market, savings, search for yield, and going back to my two distinguished panelists, this sense of trust and how you somehow safely channel household investments into the most appropriate products. I mean, I think couldn't be more important than it has been in the last 10 to 15 years. So focusing then on sort of the Commission's position, I mean, one of the things I really welcome is it's almost I see some slightly worrying signs of a deregulatory movement in some aspects of where we are on the retail agenda. So some of the council's positioning right now, for example, around product governance, seems to be just beginning to roll back some of the rules. So I very much welcome the Commission's focus on regulation and on a strong response to kind of the retail sector. But just maybe a couple of points from the CMU Action Plan. I would agree with my colleagues on the absolutely fundamental importance of advice. I think one thing we see, and that keeps getting reinforced in the studies and the literature, is the severe limitations of disclosure. It brings us some of the way, but only a very small part of the way. So while advice and conflicts of interest are extraordinarily difficult, I mean, my own view is it's the single biggest problem in modern financial regulation, how you get a conflicts of interest in the distribution process. I think we need to keep looking at it. And I know there are difficulties around an inducement ban, but I think unless we can get to a situation where we can have complete confidence in the quality of advice and how products are sold to households, that will remain a continuing challenge for how to safely bring retail investors into the investment markets. A second comment I would make is on the product governance side. I think that was a huge achievement by the European Commission bringing forward the MiFID II rules around product governance. I think it's really important to keep that focus there. So one thing I would encourage the Commission is to keep looking at those rules. How are they working? Where might they need to be strengthened? Are they closely working together with the advice rules? So we have this sort of very holistic operation between how one sells a product and the kinds of products that are being designed. I think a third point I would make is a focus on outcomes. I think when it comes to the retail markets, it's very helpful to have a sense of what we're trying to achieve. What kinds of products do we hope our retail investors pursue? You know, is it sort of index funds? Is it standard uses products? And is regulation operating in the most efficient way? So we see where retail investors are moving and behaving. So I think a really strong evidence base on what households are doing and why they're doing it. You know, if they're buying certain products that we find troublesome, why is that happening? And can we track sort of, you know, where those investor behaviors are coming from? I think a final comment on the demand side. I think it is always good to see financial literacy. It's clearly part of a much wider package here. I suppose I'm always cautious in the financial literacy space. I think it's a very long game. It's a 30, 40, 50-year time frame when it comes to educating households. It is certainly part of the wider package, but I very much welcome the Commission's focus on reviewing and looking at the inducements rules, looking at quality of advice, because I think that really is the ball game when it comes to ensuring retail investors are appropriately protected. So I'll leave it at that. Thank you so much.
Well, thank you very much. Maybe I can put to the panel some of the questions we are receiving on the chat. Two of them are related, and it is not surprising, on supervision. And maybe I can ask you, John, what is the plan of the Commission? The feeling is that in the action plan, you have identified that as an important area, as part of the building blocks that are necessary to a trustful and efficient market. But nevertheless, we are coming out of a very recent reform of the ESAs, and we all know that that discussion was difficult. So how do you anticipate that the next steps could happen?
Thanks, Fabrice. I think the important thing here is to sort of, in a sense, de-dramatize this debate a little bit around supervision, because it can become very quickly a very sort of sensitive debate where it doesn't really need to be. And to do that, you have to, focus, in my opinion, on the real issue at hand. I mean, what we're talking about here is single supervision, okay, and the merits of single supervision. Whether we're talking about a single supervisor or not, so an institutional approach, we will have to wait and see. But I think the rationale for single supervision is quite strong. Not quite strong, very strong, in fact, and it's what we say in the action plan. Now, why do I say this? Well, I say it for two reasons. One, I think if you look at CMU post-Brexit, we will create a European, an EU27 capital market, which does not resemble the City of London. So clearly the choice has been made to have a capital market that does not have one central location, that it is a multi-center capital market, which means people can enter the market in various different places along various different segments of the market. That's fine. I think we all know the benefits of agglomeration in economics, but we don't fully understand the extent to which modern technology has affected those economics of agglomeration. And it probably is the case that technology will allow us to compensate for the fact that we have multiple centers and that these may be geographically far apart. So no problem per se with multiple points of entry for a capital market, but you cannot have multiple terms of entry in a capital market that is single. If you can enter a market in different places on different terms in terms of regulation, it's not a single market. So you need a single rule book, first of all, and then you need somebody who are not somebody, but an arrangement which allows that single rule book to be applied consistently. So this is the single supervision argument, and I think the rationale for that is just irrefutable. Okay? You have to distinguish that from what was a very difficult discussion we had last time about a single supervisor. So what is the entity that does things? The reality is that there are different ways that you can deliver single supervision. Some people, and I will not offer an opinion on this, may argue that a single supervisor is the most efficient way. Others will argue that capital markets are not like banking systems. They don't lend themselves necessarily to the benefits of a single supervisor. It's all local, etc. I would suggest we don't have that argument now. I think we start with the argument, do we need single supervision? And the answer to that clearly is yes. And to deliver that, we will need a single rule book and a way in which supervision, which may be conducted locally, is somehow assured in terms of its quality. Okay, so this is not about questioning whether a local supervisor is doing a good job or not. This is about verifying, that's all. Because we are talking about trust and trust in the market. Well, if a supervisor is doing business locally that is relevant for the market as a whole, for the European Union, then it's very important that the rest of the European Union has trust in the supervision that is being conducted by the member states. This is not suggesting it's not good. It simply says it has to be verified. And there are different ways that you can, verify supervision conducted at the national level from a European perspective. One method is a European supervisor. There are other ways of doing it. There are supervisors of supervisors methods. There are various approaches. And we have taken the view in the action plan of not sidetracking ourselves into what is always a difficult discussion about institutional arrangements for supervision, but focusing on the core rationale, which is if you want a single market, you have to have an arrangement that delivers single supervision, single rules applied consistently across all access points to the market. And that's a little bit what we did. So it's not really, we have not reduced our ambition in this sense. We have simply decided to focus attention more on the core issue, on the substantive issue, and not allow the debate to be sidetracked into whether you have a single supervisor and where it's located and who heads it and who's represented on the board, etc. Let's see where that comes later. But let's get the core arguments agreed first.
Okay, thank you very much. Maybe some of the members of the panel wants to react or give their viewpoint.
Excuse me.
No comments on supervision? I cannot believe it.
No. Well, as a former MEP and member of the Econ Committee in the Parliament, I'm for a long time involved in this issue, and in principle, I like the view as expressed by John. However, the reality is that the national interests to keep also the national supervisors with, say, the national sometimes different approaches still plays an important role. So the European institutions have to be empowered in a sufficient way in order to counteract that. And it's very important that the European Parliament plays its role into supporting the European Commission, because there is always a battle on this issue, which is not only institutional, but also the battle is needed to achieve the right results.
Fabrice, if I might come in really quickly, I very much agree. Warmly, indeed, welcome John's comments, because I think this is such an enormous issue, and it sucks up so much political and academic, indeed, and market energy. Whereas actually what we're trying to achieve can be done certainly in the short to medium term, in a more simpler way. And I think, it's very hard get away from the fact that capital markets are so varied and have so many different kinds of actors, and how important conduct is. So you need that more up close supervision and so on. But I think as well, I think there are very promising signs that our current settlement, problematic though it may be, is actually working pretty well. I mean, if you think about it, the COVID crisis was a challenge to the supervisory convergence ESMA network-based model, and certainly I think it's a reasonable proposition to say it came through it pretty well. I mean, soft law was used pretty effectively. Some complex issues around short selling and around payment breaks and this complex accounting standard IFRS 9, these were all resolved, and perhaps while it wasn't as clean as one might ideally kind of hope for, it worked. So I think the EU is extremely good at building systems that can adapt and respond and flex over time. And so this sort of evolutionary approach, let's have European supervision, is the way to think about it. I suppose one thing I'd encourage a very strong focus on is what we mean by supervisory convergence. What exactly is that? How much local discretion is acceptable, workable in a single market? And at what point do we empower some kind of single actor to say, well, no, that just doesn't work as far as the single rule book is concerned. So monitoring supervisory convergence, indeed, whether it's through the European Parliament or through ECOFIN in some way, I think that's a really important place to focus on for the next period.
Maybe Fabrice, if I can just give a very short answer on supervision. I think for the moment we are not advocating. I mean, from the European Parliament point of view, we're not advocating really for a move to single European supervisor overnight. But I think we need to have a supervisor at European level that feels confident to ask challenging questions. Like without taboo, I would say. And in an atmosphere of trust, again, between all supervisors involved. That's only it. It's a short question because I would have, if you allow me, some maybe advices or answers to give on the questions on open data to financial and non-financial data. So.
Okay. Well, if you allow me, even if I'm the moderator, I cannot resist at least one comment. As a complement to what you said, Sean, indeed, in supervision, what is interesting, in fact, is where is the efficiency of the supervision? So is it at supranational level, at national coordinated, or purely national? And probably the answer is very different depending on what we are talking about. I don't know, maybe on the UCITS arena, it's very integrated. On other aspects, it's less integrated. So the answer is probably not the same, depending on the functions, the sector, the product you look at. And if there could be at EU level something to measure where is the level of integration that justifies the thinking about where is the efficiency of the supervision of that specific sector, product, or actor, would be very useful, and it will complement well your approach. Okay, are there any comments or questions? There was a question about access to data, which is especially if we move to, in the sustainable agenda, to measurement of a number of new things, taxonomy, maybe non-financial standards, and asset managers, investors will need a lot of data and the production of that data is a question in itself. Who will do it? How it will be accessible? How do we have an efficient market of that kind of data? Is this part of your thinking also, John?
Yes, I mean, what you discover in the sustainable finance agenda, as you often discover in European agendas, that you sometimes start at the wrong end. I mean, so we've started with taxonomies, and we've started with definitions and disclosure regulations and benchmarks. But what we've discovered is, of course, that to make all of these things work, you need raw data. You need so we are asking intermediaries, asset managers in particular, to report on how they're investing on behalf of their investors. But of course, the intermediary needs the raw data in order to compute the metrics which can demonstrate that it's doing what it's supposed to be doing in terms of green. So now we're coming in this next phase with a big focus on disclosure. So we will come with a reform to the non-financial reporting directive, which those of you which are familiar, and I'm sure you all are, already exists, but it has a relatively narrow scope, and it is voluntary, and it also has very broad set of, let's say, principle-based requirements, kind of almost a code of conduct sort of approach inside it. We think for the purposes that we need it, this will not be sufficient. And so we're going to have to move to an arrangement where most certainly we will have to have a wider scope. The question is how wide, and there the issue of proportionality always comes back. There are some entities you can ask to disclose, even if it's burdensome, because they can manage it, but there are other entities which are too small and will find this too heavy. So we have to determine the scope. I think they need to be mandatory, so we cannot, we cannot just rely on companies' goodwill to do it. They'll have to be, required to do it. And I think we need to probably work for more defined metrics, like standards, in fact, of what is to be disclosed, because it will need to be consistent across products, across market segments, etc. So the data that comes out of corporates about what they're investing in will have to be, as I said, consistent, available, and with the right scope. So we are currently, as you know, seeking advice on all of these things. We're using EFRAG to do that. When we receive that advice, we will then put forward a proposal. I would think we're planning at the end of the first quarter next year, and then it will go into co-legislation. But I think this is a recognition that disclosure is fundamental to our sustainability agenda, in that you cannot ask investors to invest in green unless they can be reassured that they are, in fact, their investments are going into green. And if you're to ask the intermediary to demonstrate that, then they have to have the raw data to produce those metrics. So this is all part of a continuum, let's say, of signaling mechanisms for investors in the market around sustainability. So that's what we're intending to do. And the non-financial reporting directive reform will click into the disclosure regulations. So we'll make sure they are consistent under the taxonomy. And so hopefully when we get this finished, everything will click into place and will be one continuous block with disclosure of data, calculation of relevant metrics, and then demonstration to the investor that what they've invested in as green actually is green.
Okay, thank you, John. That's very clear. I think one of the dimensions of the question was the data provider market itself and the efficiency of that market, whether it's too concentrated or not, which is part of the dimension of that issue. If there is such amount of relevant information, how it is that market of data providers itself, maybe it's part of the things that are needed for an efficient flow of information. If there are no other comments, I think, Karel, you have a question?
Yes, thank you. When I come off the screen, thank you, Fabrice. I had a specific question for Corinne and NIMF. Corinne said very clearly, we need to have a ban on inducements. And I just wanted to have her, let's say, explaining this a bit more, let's say, what she meant. And also, NIMF mentioned this whole problem which she sees with conflicts of interest. I say this specifically because there has been a lot of debate in the European Parliament, and there was a question referring to this in the context of the MiFID quick fix, that the Commission has proposed to basically make an exception to inducements if it contributes to research in small stocks, which also Stephanie referred to. I mean, however, the Parliament, at least some groups in the Parliament, have seen this as a way to basically go back to the regime which we had before, to basically have the form of inducements like we had before, which were abolished under MiFID II.
Reactions from Niam, please.
Yeah, no, thanks very much for the question, Carol. Yeah, I mean, this is something I think is something we need to be very, very cautious about. This sort of slight sense in some quarters of a deregulatory movement. So I think I'd make a couple of comments. I think the retail investor base in the EU is very new. It is very embryonic. Compared to other parts of the world, let's say the US, households don't really understand the investment process. We know where all the blocks are. They don't understand disclosure. They don't understand costs. They're extremely vulnerable to marketing. They don't really understand what independent advice means. So we're dealing with a very, very vulnerable group of consumers. So my own sense is what that means is the pendulum has got to swing very far in the direction of protection. And that means really difficult trade-offs. I know it does. But I think in terms of where we are, I think the dangers that flow from reducing conflict of interest protections, weakening the rules on inducements, even if one might see, you know, an economic case in other aspects of the capital markets, I think where we are now, given what we know about households and how they invest, where their vulnerabilities are, certainly my own sense from, you know, the deep problems conflicts of interest causes, we have to keep incredibly focused on that. Now, my own sense about the inducement ban is, I think while it's a very brave and difficult thing to do, I think it is a very, it gets to the root of the conflict of interest problem. And certainly one thing one would have seen in the UK when it experimented with this is it does drive a move into simpler products, simpler distribution systems, which can have positive outcomes then in terms of this sort of holy grail of simple products getting to investors through low cost distribution channels. So yeah, my sense is right now that the cost benefit in the conflict of interest space is very much on, you know, the retail investor side, and perhaps the burden of regulation still staying on that side.
Thank you. Corinne?
Yes, if I could add, what I like also in the approach of Niam is that she broadens the issue. It's not that when you introduce an inducement ban that solves the issue for households and what you want to achieve, because what you want to achieve is that households currently in the current lower for longer interest rate environment, it's very difficult for them to take care of their savings through banks. So the need for retail investment products has increased, and what I would like to recommend is well. Look into the evidence and the research in those countries who have introduced inducement ban or taken steps into that direction. So it's not a yes or a no, because it's not only about independent advice, but as Niam rightly said, it's about simple and fair and cost-effective investment products with the right level of retail investor protection. So it's much more, it's much broader, but take the evidence from those countries, and the Netherlands is one of them who have taken steps in that direction. In the end, the level of retail investments increases when there are more simple products, when there are steps taken towards fair advice or inducement bans. So take that evidence.
Okay, thank you very much. So time is running, but maybe to conclude this panel, I have two questions that come from the discussion. I think the two interesting words that we heard was trust and holistic approach. On trust, a general question is whether the Wirecard scandal created a sort of need to restate the need for confidence in the market. And I would be interested to know what are the intentions of the Commission in terms of responding to that. There are, of course, legislative initiatives in Germany that was obliged to happen. But the question is how these three big questions that are how payment systems are supervised in Europe, are governance and disclosure rules properly implemented in member states, and are auditors' work unquestionable or not? So there is at least three questions where some reassurance needs to be sent to the market. And the other point is your issue of, it was interesting, Sean, when you presented the CMU so closely connected to digital and sustainable. And I was wondering whether if you connect that with this idea of KPIs and the need to avoid what happened last time, which is that discussion goes into very technical council working groups and you lose the whole meaning of it, whether there is a way of creating a sort of objectives, but concrete objectives, KPIs and concrete objectives, and you have a sort of steering or monitoring group that on a regular basis checks that progress is happening, not the legislative side, because that's the role of the Commission, but in addition to that, really concrete KPIs in the market or scoreboards where you can really put around the table those who are able to unlock the situation, and you regularly explain where are the blocking points, and you can keep the momentum during the next 4 years. And I do believe, as Corinne said, that it should not be only the list of the 16 CMU action points you have identified, it should be also the digital agenda and the sustainable finance program you have in mind, and all that should be monitored. Whether you give a name to that umbrella, it could be a good idea, especially for because we are lucky to have now a commissioner fully dedicated to financial services, which is very powerful to make things progress. So would you see merits in creating such a umbrella embracing the 3 or 4 blocks and monitoring that on a regular basis to keep the momentum? So these are my 2 questions. How do we ensure trust and confidence post Wirecard, and can we create a tool to keep the momentum? Sean.
Okay, thank you, Fabrice. I will answer quickly so that other members of the panel will have their chance. On Wirecard, like any such event, I think there is always a risk that such a big event will undermine trust more generally in the market. It doesn't have to be in Germany. It causes everybody to think about the risks that there are in markets. We tell people all the time that markets go up and down, but this is a somewhat different story here when somebody feels that there's a lack of sort of oversight, a lack of how do I put it, a lack of functionality in the market that can really fundamentally, and we saw this before in the past. It's what worries me quite a bit around the digital space, that we just need one huge crisis in digital space, and trust in the digital finance agenda entirely could be damaged. It's one of the reasons we're coming forward now with a regulatory framework for that. Of course, we asked ESMA to do this study on Wirecard, and we asked it particularly for the reason that you said. We need to understand to what extent this is an idiosyncratic German problem, so something which went wrong with the way in which Germany applied the EU framework against what might be wrong in the EU framework itself. I think the report is very strong. It's a good report. We're studying it now to extract from it exactly what I said. What is relevant for Germany? What of it is relevant for the EU framework? And if we find in that report something which is relevant for the EU framework, then we will address it and we will fix it. I think myself, I've not read it, I'm reading at the weekend, it's my weekend reading, believe it or not. It's going to be a mixture of both, frankly. That's my guess. On KPIs, I should tell you, we have a study out there, which is to develop KPIs for us. This is not the first time we've talked about KPIs. The challenge around KPIs is to find indicators that can be sufficiently isolated from the effects of other factors to allow you to conclude that it is a measure of whether your policy action is working or not. So a classic example would be the number of IPOs in the market. Okay? We might want to see whether or not our IPO fund or our better access to SME data is helping with the number of SSME listings in the market. Of course, we know that the cycle of the economy will also affect that. COVID is going to affect that. So how you isolate in your KPI those elements which are somehow, at least somewhat directly linked to your policy action from all these other extraneous factors is sometimes difficult. And so we've had this study, we're asking exactly this question for people to sort of help us. And if I think we get a set of KPIs that can do that, then of course we will look to do something like you said, Fabrice, to come up with a monitoring system which can at least demonstrate to the political level that the policy actions are working. Because I think, if I may say, one of the problems with the political commitment to CMU is that they see it as a nice to have, whereas many of us see it as a need to have. And if you can demonstrate that what you're doing has these effects, then I think it's easier to make that case that this is not just something that let's give it a good try, and if it works, it works, but it's something that you really need to work at and you need to have it. And I think, we've always focused on capital market integration from the growth agenda. It's a resource allocation issue, and less from the strategic agenda. But I think, the argument now post-Brexit and with the way the geopolitical system has evolved over the last number of years, and I think will continue to evolve in the same direction, CMU is more of a strategic discussion than just a kind of growth and enhancement discussion.
Thank you, John. Any other remarks, Stephanie?
Yeah, thank you. Well, I would have many other remarks. In fact, it's very, very stimulating and interesting, but time is running, and sorry, because I will have to rush to another meeting. I was about to leave at 10:10. So, but in conclusion, to answer your question, Fabrice, let me step aside from CMU for a minute and tell you an anecdote that shows what European citizens are really expecting from Europe on financial questions. And this is a link with one of the last questions on the chat. And the question is definitely how we can build trust step by step, and what are the KPI we need to look at. When I met with entrepreneurs and small business owners in Normandy in July with the French minister dedicated to SMEs, the first thing the entrepreneurs said when I told them was working on financial matters. What would Europe do for our coverage of pandemic risk in our insurance contracts? They felt that they were not accompanied as they should have during the difficult time, and that the only answer they were getting is, this is not covered in your contract. To me, this is the symbol of where we can collectively do better instead of starting maybe from the existing rules and existing institutions. I think we have to think first about what our consumers and our businesses need, and then find appropriate and concrete, as you said, solutions. Pandemic insurance is just, I think, a shining example, but I'm also thinking about consumer credit, about mortgages, as our new commissioner McGuinness mentioned in a hearing in the parliament. And of course, in the CMU context, about all the initiatives on retail investment. So in the week of the American elections, maybe we should not ask ourselves, what can consumers do for CMU? Maybe we should ask ourselves, what can Europe do for our consumers? And sorry, I have to leave you, but it was very stimulating, and thank you so much. I hope we'll have the chance to discuss again, and keep safe and have a nice day.
Thank you very much, Stephanie. Thank you very much.
Thank you.
Well, we need to come to a close anyhow. Maybe Corinne or Nayam, a last comment, and then we close the session.
No, just I want to echo that the holistic approach, as John presented it, and also your response to, well, trying to measure the effects in the real economy and on citizens. I think that's very important to really bring it to the CMU to the strategic level of what we want to achieve for our citizens and our economy. That's just what I wanted to highlight. Thank you. Thank you so much for this panel.
My pleasure. Very good to see you, Corinne. Naeem, last comment? And
really quickly, Fabrice, yeah, for me, the message, the wirecard message is just how seriously wrong a financial market can go, and the exposure households can have when that happens. So I think it's a reminder, very much as Stephanie said, it's not so much what consumers can do in terms of mobilizing their capital, but it's how the regulatory system can protect them and secure them at the same time. Thank you.
Okay. Well, thank you so much. Thank you, all of you. Thank you, John, for all this very interesting information and the program for the future. And please keep safe, and we look forward for further discussion in this. Thank you very much. Bye-bye.
Bye.
Thank you.
Bye.